Hi, welcome everyone, and thank you for joining us for today's webinar. My name is Mary Jane, and I handle event and marketing at Singapore FinTech Association. Today, we will be presenting a webinar part of our Strengthen Your Business series titled Tax and Restructuring 101 for FinTechs. Speaking today, we have Gamazi Rashid, partner of Deloitte in the Southeast Asia region based in Singapore, and Matthew Levitt, Director of Financial Services Tax, Singapore. Just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the question box in your Zoom control panel below. It will be brought up during the presentation, and we'll also have time for questions at the end. Now, without further ado, we will turn the time over to Gamazi. Gamazi, please.
Thanks, MJ. Maybe I'll share my screen right now for the slide. Would you let me know when you can see my slide, please?
Yep, we can see your screen.
Okay, thank you. So let's start proper. Again, thank you, everyone. Good afternoon, and thanks for joining the session today. So I'm going to take half an hour later to go through some key accounting topics. And these topics were collated based on the frequently asked questions from some of our clients that we worked with. So as a background, I do accounting advisory work in Deloitte. My clients not just in Singapore, but across Southeast Asia, although I am based in Singapore. And I hope the session will be useful for you. After my session, half an hour, I will hand over to Matthew, who will be covering the tax bullets that you see on the screen. Yeah. So let's start proper. Okay, there are a few issues that I wanted to share with you, beginning with revenue recognition. And this is, of all the questions I received from my clients, this is the top of the list. Many questions in revenue recognition, especially when it comes to the timing of revenue recognition. So maybe I'll go through a very simple example, like a story, if you will. So this gentleman called Jojo Tan, don't ask me how I got his name. My team members prepared this deck for me. Anyway, Jojo Tan is a general manager. He works in a company that provides financial services. So a multitude of different things, financial products. They also do consulting work, i.e. services, and customers are all across Southeast Asia. And as I mentioned, he's a GM, and he has some specific concerns on growth and financial health. So it's not just a P&L, but balance sheet as well. So I will use this persona, Jojo, as I go through some of the FAQs beyond revenue. We've got other things like share-based payments and stuff like that. Okay. Now, Jojo understands, he's not an accounting person, but he does understand that in order for him to make effective decisions, or probably to avoid unintended accounting consequences, he needs to work very closely with his finance folks, right? So that's the key takeaway for Jojo. And I guess the takeaway for the folks on the call who are running your own business as well and are not finance people. Now, let's take a look at what Jojo is intending to offer, right, to his customers for FY 2022. So he is intending to come up with a plan where the customer pays an upfront onboarding fee, right, of 1.225 Singapore dollars. Okay, and as part of that plan, obviously he will start to onboard the customer, register them, give them access and stuff like that, which can be seen as administrative in nature. Okay, and what the customer gets in return is essentially a free 1-hour consultation per month. So essentially, his company, Jojo's company, will stand ready, right, to provide any consultations for 1 hour every month to a particular customer who signs up to this plan, right? And on top of that, to create some form of stickiness, he's also offering a $25 voucher for the purchases of financial products by those customers who sign up. Okay, other people do not get this voucher. Only people who sign up for this plan will get this voucher. Okay, so in terms of cash flows, what he charges the customer is 1,225 on day one, right? Subsequently, for the rest of the year, customers pay nothing. So essentially, these are freebies, right? The last two items on the right are freebies. Now, the question that we've always been asked, or not always, but common question is, how would the revenue look like, right? Do you record 1,225K in day one in January, and thereafter up to December, no revenues at all, right? That would be the first inclination for many of us, right? Because that's what January is the time when we receive cash, right? And we don't need to do anything else except to stand ready to provide consultation, right? And this voucher also, there's nothing that we need to do. When the customer buys, customer can use the voucher. That's it. However, there's also another perspective to this, which is on the right. So this is a bit more complicated. So you see here, instead of just services that you see here, the contract is subdivided into multiple things. So you can see consultation, onboarding, and the voucher, right? And you can also see the key difference between this view and the one on the left is that the revenues do not get recognized in January. It's actually spread all over the month, all over the year rather, amounting to 1.2K. And there's also a voucher element that revenue is allocated to as well. So the key observations, as you can tell, is that it's not just one revenue stream that we have here. It's essentially two, right? Consultation and voucher, right? And timing of revenue recognition is also spread across the 12 months rather than one point in time in January. So which one is correct? Now, off the bat, I can tell you that the mindset you need to take would lead you to the answer on the right. Okay, so to deep dive a bit more, firstly, before I explain this very busy slide, the accounting requirements for revenue recognition is very complex. Okay, to the extent that we need to have specialists within Deloitte just focusing on revenue recognition alone. And you can ask any accountant that you know, they should also acknowledge the fact that revenue accounting is very complex. And this complexity came up in 2018 when there was a new revenue accounting standard that took effect. So for the last 4 years, we've been trying to grapple. We're still trying to grapple with some of the accounting issues with revenue recognition because of the standard being so complicated and so prescriptive. Okay, now let me deep dive into this example proper. So as a recap, 1225K on day one, right? And thereafter, no cash collected, but there is a continuing obligation to provide consultations, and there's this voucher hanging above our heads, right? Above Jojo's head rather, when the customers exercise. Now, let's go step by step. The first thing that you need to be aware of in the course of you planning a sales scheme is that when you offer multiple things in a contract, you need to make sure revenue reflects those multiple things. Okay, we call it in accounting parlance performance obligation. Okay, so if you look at the contract, there appear to be three things being offered: onboarding, consultation, and the voucher. But you can see that onboarding has $0 attributed to it. And the reason is onboarding, it seemed to be an administrative process. The customer doesn't really get any benefit, right? You're just onboarding the customer, granting him or her access, and that's it. So the view that would likely be taken is that only these two, consultation and voucher, are the ones that benefit the customer directly. Okay, that's the first takeaway. So it's very granular accounting, right? You need to slice and dice the contract into the different performance obligations. Some people say promises is the same thing. Promises is equivalent to a performance obligation. Okay. Now, the next thing you need to do is the total contract price, 1225, is now divided between these two performance obligations. Okay. There's a certain formula that you need to use. I will not belabor the point during this call because we are not expected to be accounting experts, right? But what you need to know is the 1225 will be allocated between these two revenue streams or performance obligations. That's the second key takeaway for you. And perhaps the final takeaway, which is the key, is that revenues do not get booked in January alone. In fact, some of the revenues are deferred from January all the way till December, right? Because that is the period in which Jojo's company must stand ready to provide consultation to the customers as and when they come to the company. Okay. Now, the other bit that you may be asking yourself, what is this voucher here? It's just a piece of paper, right? That the customers can use to defray future costs. But like I said, this is a performance obligation. The company is standing ready to provide this discount as and when the customer comes. Okay. And why is it booked in December? I'm assuming in this scenario, the customer doesn't use the voucher at all, in which case the voucher gets booked as revenue only in December because that's when the voucher expires, right? Because when the voucher expires, you don't have any voucher, above your heads to be called that may be used against you, right? So that's why you can book $25 in December. So I've spoken quite a bit. I hope at this juncture you can appreciate that one contract alone like this can involve a lot of steps, right? And your accountants are the ones who are going to do all these things. Obviously, there's more steps than this, and this is a very simple example. But the key takeaway for you is before you start any new sales schemes, be very sure to consult your finance folks because they may have a point of view on the revenues that will emerge in your P&L. Okay, now, like I said, the key takeaway here is granularity of accounting because you need to slice and dice the contract, and the timing of revenue recognition, right, which is spread rather than a point in time. Okay, now moving on. So if you think about other scenarios that may be applicable to your context, I've just laid out here some of the common ones. You sell a car and you do free shipping. Now that free shipping may be a performance obligation and you need to allocate revenues for it. So by the time you sell, you can only recognize the revenue for the car. Yeah, the shipment activity, revenues attributable to the shipment activity gets recognized as the shipment happens. Okay, so I won't go through every single example here, but you get the message, right? You need to slice and dice the contract into multiple parts. Now, in the context of, so one client recently asked me, I provide loyalty points to my customers, right? And those loyalty points can be used by my customers to redeem for free goods or discounts in the future. Now, those loyalty points are similar to the discounts that I just went through with you just now. Okay, so you end up having to defer revenues in respect of those loyalty points. So just be very careful. Okay. Now, other scenarios, like I said, the standard for revenue recognition is very complicated, very extensive. There's a 300-page book that sets out the rules for revenue recognition. So I hope you can imagine how granular it is and how complicated it may be. And couple that with the complicated offerings that you have, it becomes even more complicated. Now, other issues to share with you, the more commonly asked one, I mentioned this just now, right? Whether revenues should be booked at a point in time or should be spread over in future years. That's one of the common issues we've seen. The next one is buy now, pay later schemes. Now, this is typically when the customer pays you later for something that you deliver now. So the viewpoint taken by the people who write accounting standards is that there's a financing arrangement, right? You're financing your customer. And therefore, out of the amounts you receive, take, for example, the 1225 we saw just now. Out of the 1225, part of it will be taken out and recognized as interest income and presented as such in your accounts, despite the fact that you really don't charge any interest. So it's an imputed interest, so to speak. So just be careful of that because you may have a very strange looking P&L when you finally apply this revenue accounting standard. Volume rebates or loyalty rebates, you may have adjustments to contract price, for example, which includes volume rebates and loyalty rebates. So the question is, when do you adjust for these rebates? When it happens in the future, or do you do some form of estimation right now? Now, the consensus is you need to do some form of estimation. So just watch out. If you do have any provisions in your sales contract that allow for rebates or adjustments, you may have to start adjusting your current revenue numbers in respect of those expected future rebates. So just be very careful. Okay. And finally, this is a very complicated area. And even after many years doing accounting advisory, this is an area which I find very hard to grapple with. And this is what we call a principal agent situation, i.e., whether you report your revenues gross with the corresponding costs, like the first one here, $120 cost, $120 revenue and $100 cost. P&L is 20. So net P&L, no impact, but the gross presentation is a key difference compared to the alternative where your top line only shows $20. Okay, and this is quite common when you are an intermediary in a supply chain, right? So should you record full gross amounts for the amount you receive from your customer and the corresponding costs to the supplier, or should you record just net, right? Because it may be argued that you're just an intermediary, you're just putting two people together, therefore your top line shows $20. Now imagine the impact on your accounting matrix, right, or your financial matrix when you have to show net versus gross. It can be quite a significant effect. Okay. Now, key takeaways, I'm repeating myself in some of these points. Number one, revenue accounting can be very complex, right? The standard itself is very complex, and your offerings can be complex as well. Put them together, it becomes even more complicated. Make sure you have a good idea of your revenue profile, expected revenue profile when you plan for sales schemes, because you do not want to be caught with unintended accounting consequences down the line. So to remedy this, do involve your finance folks early. in some cases, they may need advisory help as well from specialists, right? So before you sign any contract, make sure you do this. Otherwise, you end up with something you can unwind. Okay. So that's all I have for revenue accounting. I hope that was digestible, right? And I hope I haven't scared you that much. So let's move on to share-based payment schemes. Now, before I continue, any questions I'm happy to answer, perhaps at the end of my presentation. Now, employee share schemes. Now, let's go back to Jojo. Now, Jojo being a startup, right? He wants to compensate some of his key staff with employee stock options, or ESOP, right? ESOP stands for Employee Stock Option Plan, okay? And obviously, the benefits are it helps with cash flow. You don't have to pay in cash to your employees for the compensation, but you're also aligning their interests with that of the companies, especially if you have IPO aspirations. Because if they have shares, and IPO happens, the employees benefit as well from the price uplift, right? So what Jojo is thinking is that to lock these employees in, or in order for the employees to earn these stock options, they must work a minimum for 3 years, right? Then the options will vest. Okay, vest meaning the employees are entitled to exercise these stock options to get shares in the company. Okay, so he also wants to incorporate a $1 strike price. Employee just pays $1 for a share that might be worth $10, for example. Okay, and as a sweetener, he also thinks that let's let the staff hold on to the shares even after they leave before IPO, right? Because the incentive is already earned. They work for 3 years. If they want to leave, fine. They can still exercise these options in the future. And these are all quite common. Okay. Now, how do the numbers look like? Now, if we look at the fact pattern above here, these are a reproduction of what we saw on the previous screen. And let's assume this is just one employee number 231. Now, just to recap, the employee must work 3 years before the options vest. Strike price $1. After 3 years, as long as the options have vested, the employee, even after leaving the company, can still exercise the option in the future. Okay. Now, assume the grant, this is an additional fact. Assume the grant is given on the 16th March, which is today. Okay. So therefore, it vests 3 years later from today. Now, how do the numbers look like? And that's what you see in the table below. In your P&L profile, you will have, maybe I'll just move to the right first. What the company needs to first do is to value the grant. Do a valuation, and that valuation is time specific as of 16 March. Okay, so that means if employee 235 gets grants in a month's time, similar terms, except that the grant date is different, a valuation would need to be done at that time. Okay, so just be careful if you grant options or ESOPs to different people at different points in time, you may be saddled with the burden of having to do multiple evaluations, right? It's not just a burden of your time, but also the cost that you need to engage valuers to do those valuations, right? So typically what we see is people granting to 10 employees in a single day. So you just do a valuation once for that day, right? Because each day of difference will lead to a different valuation. Now, so the valuation done on day one, and if you look at the financials, there will be a P&L charge. Right here, out of the $300 valuation that was done, is spread over 3 years, which is the period in which the employee has to work. Okay, the period over which the employee has to work. Now, the corresponding impact is to equity reserve on the balance sheet. Okay, so you can see there is a P&L impact. That's one thing. There is no impact on your resources. There's no cash outflow. There's nothing that you need to pay except for share issuances in the future. And that's why you just see a hit on the equity. Okay, pretty straight line, pretty straightforward. We call this an equity settled plan because you don't have to pay cash. You pay nothing except for issuing share. Okay, it's the shareholders themselves who are bearing the burden of this plan because their interests are diluted from the issuance of ESOPs. Okay, now, one thing that you need to be aware of is that if the employee leaves before the vesting, before the end of the vesting date, before the end of the vesting period, rather, any expense you recognize will be reversed. So in this case, if employee 231 leaves in the middle of year 3, and by year 3, you have already booked a $200 in expense, and that expense gets reversed out as income in year 3 if the employee leaves. Okay, so imagine this: you have multiple employees, Some of them leave today, some of them leave 3 months later. So there's a bit of tracking you need to do. And that's an additional administrative burden you need to think about for your finance folks. Okay. Okay, now, common question, right? It's common that people issue ESOPs, but there are additional concerns by those who do. First concern, I don't want my employees or non-employees to hold our shares. Maybe because of competitive reasons. Once someone leaves, although the options have been vested, the company may not want those employees to hold on to the company's shares because that company, or rather that employee, may work for a competitor. And you don't want that employee to come for general meetings of shareholders in your company, etc., right? Another concern that we've heard is, I want to enable my staff to encash before any IPO happens. Because if you put yourself in the shoes of the employees, they have these shares in a private company and they can't readily trade them before IPO. So some companies decide, let's just encash it for the employee, right? Before any IPO. So there's some exit mechanism for the employee. Now, in this case, what Jojo is trying to do is, given the above concerns, he wants to allow the company to buy back the options and buy them back at fair value so the employee can walk away with cash instead. So there are some issues with this before he embarks on this change. First one, if you look at the bit here, in the past, under an equity settled plan, we see this as an adjustment to reserves, right? But now it's a liability on your books. So it moves up from equity to liability. So obviously your debt equity ratios is going to be out of whack because this reserve ends up being a liability on your balance sheet. The other key takeaway you need to be aware of is that in just now's example, we saw a $100 straight line expense, but now $100, $150 in year 2, $120 in year 3. So it's quite volatile. And why is it volatile? It's because the encashment is based on the fair value of the grants, which changes over time, right? So before you start embarking on these adjustments to the equity settled plan, you need to consider this implication, i.e. liability classification and the volatility in P&L as a result. Okay, so we call this a cash settled plan because there's a cash payment that may be required to be made, right? Okay, so the other takeaway I want to highlight to you is that sometimes it's very hard to distinguish between an equity settled plan and a cash settled plan. Okay, so I guess similar to the takeaway I shared just now on revenue recognition, make sure that you consult your finance folks before you start to roll out this plan. There may be unintended accounting consequences. Okay. Now, if I may move on. Next FAQ, fundraising. Have I issued a debt instrument or an equity instrument? Now, I've got quite a busy, wordy slide. Okay, so Jojo, he's exploring the following. Right, these are some options available to him. He doesn't want to raise shares through issuance or he doesn't want to raise funding through issuance of ordinary shares. He wants to make it more flexible for the investor as well as for existing shareholders. So he's thinking about convertible debt, where the holder gives a loan to the company, but the holder can convert to debt in the future. So typically when this happens, the coupon rate is lower than market, right? Because the holder has this benefit of being able to exercise for shares. Okay? And you don't have to pay in cash, right? You just get the holder to convert to shares instead. Now, there's also preference shares, and preference shares can have many terms, right? There's many kinds of preference shares out there. Okay, and typically preference shareholders get preference over investors when it comes to dividends or proceeds from liquidation. And there's something else called what we call a perpetual debt, where it's a loan, but the loan will never be repaid in terms of principal. Only the coupons will be paid, and that coupon will be in preference over the ordinary shareholders' dividends. You should be able to see this in the market right now. It's pretty common. Okay. Now, what's the issue I'm trying to highlight? Oh, before I go to the issue, right? There are some variations to each of these, right? A convertible debt can be mandatory redeemable, mandatory conversion, and a whole lot of different variations. Okay, there's no single instrument there's no exhaustive list of instruments actually that you can use to raise debt. But the common denominator behind all these instruments is, how will it appear on my balance sheet? Is it a debt, i.e. a liability, or is it an equity item? As you can imagine, your financial matrix will totally go out of whack, right? If you assume it's equity, but your auditors later tells you that, hey, this is a debt instrument. Oh dear, you got a problem then, right? So that's the key concern. Okay, now, few takeaways. I'm not going to give you an outright answer because there is no outright answer, straight answer to this, right? This is a very complex area and the accounting rules are very, very prescriptive, right? It's almost as prescriptive as the revenue recognition rules, okay? But generally speaking, what would lead you to debt classification is when there is an obligation to pay cash. For example, if for convertible debt and the holder can convert to shares, but the holder does have an option to redeem and ask the company to pay cash, then you have an unavoidable obligation to pay, okay? So that will lead to a liability classification. The other situation could be a convertible debt, but the issuance of shares is not a fixed number of shares. It's a variable number. And because of that, there's some element of speculation involved, right? In which case, this becomes a debt instrument. And finally, once you have a foreign currency element, for example, you are a Singapore dollar company, but you issue a convertible debt, for example, in foreign currency, automatically, this debt is a debt instrument. Okay, it's a liability instrument because of the foreign currency element. Okay, so there are some justifications on each of these general points, 1, 2, and 3. I will not belabor each one of them, but just so you know, the rules are very, very complex. And one small change in the shareholders agreement detail may lead to a shift from an equity classification to a debt classification. Okay, so there's a key takeaway perhaps. So other key takeaways to simplify, just because you see the instrument, it is named debt, it is not automatically a liability. And vice versa, just because the investment instrument is called shares, like preference shares, it does not mean those preference shares are automatically equity. Very complex area. In fact, within the big 4 firms, accounting firm, we have dedicated specialists looking into financial instruments like this. Okay? Because the requirements are just too much for one person to handle, right? Amongst other things we need to do every day. Now, the devil's in the details. I can't re-emphasize this too much. One small change in the shareholders agreement or the loan agreement or whatever agreement might shift the treatment from being an equity instrument to a debt instrument. So just be very careful. So do get advisory support. My suggestion to you is to do so, to get support before you start finalizing the fundraising contract. Okay. Okay, let's move on to the next topic. Volatility. I've mentioned quite a bit about this just now under share-based payments, as well as the debt instruments versus equity instruments, but a bit more deep dive, if you will, right? So typically what creates volatility in your P&L are those where they are measured at fair value, because you can never predict what the fair value is tomorrow, right? Things might change. So typically items that are measured at fair value on your balance sheet include things like derivatives, right? And certain liabilities. We had just now one example for cash settled ESOP, which needs to be remeasured at fair value every period end, right? So that will create the volatility. Now, other kinds of instruments or other kinds of assets that may create volatility are things like investment properties. Now, these are properties that you hold for rental income, not self-occupied ones, but for rental income. And these are typically fair value every period end. So these are the typical items. It's not an exhaustive list, obviously, but the typical items that do create some volatility in your P&L. Okay. Perhaps another common one, and I think this is something that you guys would know very well, FX, right? The FX volatility is something that will affect you. And typically, if you have a foreign currency money-free item, right? Money-free items are those things like receivables, payables, loan receivable and loan payable inclusive. Those, if they are in foreign currency, they will be remeasured at the year-end exchange rate, and that would create an FX element of volatility in your P&L and balance sheet as well. Okay. So pretty 101, I guess, right? Because that's the objective of today, right? 101. Now, how do you manage this? Typically, hedge accounting, right? You may enter into derivatives that have an equal and offsetting impact. Well, not necessarily equal, but at least offsetting impact to the fair value exposures you see in 1 and 2, right? For example, you may enter into an FX swap contract that converts your US dollar debt to a Singapore dollar debt, for example. So you are mitigated from any FX exposure. That's what people typically do, right? But whether to do it or not, whether to hedge or not, it's a business call. Some people decide to run with it, right? Yes, I'm exposed, but I'm prepared to run with it. Okay. Some people do not want it, so they pay the cost of hedging to have a more stable P&L. So it's a business call at the end of the day. You could also have natural hedges. Now, what I mean by natural hedges is that, simply put, if you have a USD receivable, you are a Singapore dollar company, but you have a USD receivable, you may manage the FX exposure by having a USD borrowing, right? So it's back to back, it offsets each other, right? So something that you can possibly engineer as a form of natural hedge. Okay, I guess I'm moving on to my last topic, very controversial topic, expenditures. What can be capitalized on your balance sheet? This is a very, very common question that we hear. Okay, what I have is a simple list of examples of costs that do not qualify for capitalization as a rule, right? As a rule, and costs that do qualify for capitalization. Now, let's draw our attention to the left side of the screen. Startup costs. Startup costs like incorporation costs, pre-opening, right? You may incur costs before you open a particular outlet, for example. Any other pre-operating costs. Training, right? You may train your team members, your staff, etc. All these are not capitalizable, right? As a rule, okay? As a rule. Advertising and promotion. This is a bit contentious, at least in my view, because many people argue that I spend tons of money to promote my brand, right? Not only to promote my products, but to promote my brand. And this spending will benefit me for many, many years to come. So why should I charge them to my P&L this year? Shouldn't I be allowed to capitalize it like an intangible? Now, the answer to that is, unfortunately, there's arguments for and against capitalizing these kind of costs. But on balance, the consensus among the IFRS standard setters, which is what we do have in Singapore, as well as US GAAP, is that these costs should be flown to P&L. Should flow to P&L, right? I guess, and don't quote me on this, but my sense is that it's more to avoid abuse, right? Because where do you draw the line between what will benefit you this year and what will benefit you in future years? So charge everything to P&L as a matter of expedience. Okay, don't quote me on this, but that's what I feel, right? Because it's quite hard, right, to determine what will benefit you in future years to come. And that's why brands are also charged to P&L unless you've acquired them from someone else, right? So if you've acquired another business that has an existing brand, the costs associated with that brand can be capitalized, or rather should be capitalized on your books. Okay, only those self-generated brands you can't capitalize. Likewise, for customer lists, you may have built up a list of customers, their contact numbers, their preferences, and stuff like that. Now, these are intellectual property that are valuable, right? And you may say this is an intangible. Yes, from a business standpoint, it is. But because it's internally generated, the rules, unfortunately, do not allow you to capitalize. Unless, like I said, you acquired those customer lists from someone else. Okay? Again, the reason why there's a rule to prevent you from capitalizing internally generated customer lists is what kind of costs fall into generating customer lists, right? Because you build a customer list through future interactions with your customer, when you make sales with them, when you interact with them or do business with them. So what part of the business cost do you then attribute to this intangible? It becomes a bit hard to argue, right? Hard to draw the line. Okay. Now the next one, research costs. Now, I will explain a bit more on this when I talk about R&D. I'm sure many of you are keen to understand a bit more about treatment of R&D costs, and I'll come to that when I talk about development costs on the right over here. Okay, but first things first, let's talk about the other typically capitalizable costs. Okay, the first one, fixed assets. We all know fixed assets can be capitalized or should be, including those direct costs in buying the fixed assets, like stamp duties, like legal costs in drafting the SMP contract and stuff like that. Prepayments should be capitalized. You may prepay insurance for 12 months. You don't charge the entire amount to P&L now. You spread it over the next 12 months. Because the benefit is very clear, right? The benefit is clearly going to be benefiting you in the next 12 months rather than now, immediately. Okay, so you do capitalize those as a prepayment and spread them over future years. Now, the next one, which is pretty commonly asked, website development costs. Now, generally speaking, website development costs should be capitalized, right? Provided the website that you are generating or developing will generate direct revenues. Like, for example, an e-commerce platform, right? It enables you to get orders directly from your customer, or rather enables the customer to place orders directly with you. Now, those kind of costs for the website are capitalizable. However, if it is simply a website like a blog, for example, right, where you showcase your company, talk about your people and stuff like that, those costs are not capitalizable because it's part and parcel of advertising and promotion. Okay, so I repeat myself again. Only website development costs relating to a website that generates direct revenues, you do capitalize. Otherwise, P&L. Okay. Now, next one, development costs, R&D. Okay. Now, for R&D, there's an R, which is the research, and then there's a D, which is the development. Okay. Simply put, any cost associated with R, research, goes to P&L. Any cost associated with the D, which is development, you can capitalize. In fact, you should. Now, the problem is, where do you draw the line? Maybe first things first, what is considered development cost? So I've extracted, I can't run away from putting this down, right? The definition of what is development cost. Essentially, you need to be able to prove that the cost for development is to facilitate or to enable commercial production, right? So the research has been done, the knowledge has been gained, you now have a better idea of what to develop for commercialization. And those costs during the development phase for commercialization are the ones that are capitalizable. Now, practically speaking, it can be very difficult to determine what goes into R, what goes into D, right? And this will require your finance folks to really track each and every dollar, well, maybe not each and every dollar, but each and every material cost incurred, right? For example, the time spent by your employees in research, how many hours did they spend? The cost associated with those hours goes into R. And the time that they've used to develop during the development phase, you need to be able to track so that you can determine the dollar value for capitalization purposes. So this can be a very practically challenging to prove, because you need to be able to support the fact that those costs are incurred during the development phase. So record keeping is very, very important. Okay. Now, one thing that people may ask me, hey, can I may have some research costs that I've incurred, but I realize that, hey, later it's feasible, commercial production is feasible already. Can I go back and start to reverse all those expenses I've had in the past and capitalize them? The answer is no. Okay. Once you've charged them to P&L's research costs, at that point in time, you are not sure whether you can develop commercially, right? So you can't later turn around and say, okay, I'm going to claw back these costs in P&L and start to capitalize it as development costs. Unfortunately, you can't do that. Okay. Now, I've come to the end of my deck, and happy to take any questions. Alternatively, I'll send this over to, or flip it over to Matt. So MJ, how do you want to do this? Should I address the questions now or later?
Yeah, I think it's good to address some of the questions now, so we don't really have to go back to the specific slides later. Yeah, we do have a few questions in the Q&A box. Not sure if you can see them.
Yeah, I can see them. I'm not sure whether our attendees can see them. Maybe I'll just articulate them.
Yeah, sure, that'd be great.
Okay, so I have 4 questions in front of me. The first one, in the example I provided, why is the $25 voucher deemed as revenue when it is a cost from the company to the client? Very good question. Let me just go back to the first slide. So this is precisely the contention that the standard setters were faced with. Here, we're talking about this one, right? Yeah, the voucher, isn't this a marketing cost, right? Isn't this a marketing cost? And many people have asked this question. In fact, one of my clients, they sell, they are, okay, I can't say what they sell, it's going to become very obvious. Let's say they sell cars, right? And if you buy a car from them, they'll give you a free rice cooker. So are you going to show rice cooker as a separate revenue stream? Because at the end of the day, the rice cooker is just a marketing gimmick, not gimmick, a marketing incentive, right? Just like the voucher. So can't you treat this voucher like a marketing expense? So there are there is logic to the argument, obviously, right? But then again, if you think about it, it's anti-abuse, right? Anybody can argue that, hey, this freebie I'm offering is a marketing incentive, right? It will never end. People can engineer their P&L to arrive at a conclusion that whatever core offerings they have are actually marketing incentives. So in other words, where is the line between marketing incentives and core offerings, right? So there is a potential for abuse, right? And I guess a balanced outcome by the accounting standard setters, sorry, we have to draw this line. There's no such thing as marketing incentive. Everything that benefits the customer, you treat this as a separate revenue stream. Okay, so I hope I've answered that question. May not be a perfect answer, but it is what it is. And this question has been asked many, many years before this standard was issued, when it was under the development. Okay. Cryptocurrency. Next question. Is there any guidance on this? Now, cryptocurrency is a fairly new area. Well, not fairly new in the market, but fairly new in the accounting profession, right? And there are multiple views as to what and how a cryptocurrency can be accounted for. And Matt, we've had exchanges, you and me, in the past, many, many years ago on this. And the current situation right now, everyone, is that there is some guidance, right? But there is no clear conclusion on some items. Because why? You can't just say that, oh, cryptocurrencies are accounted for according to A, B, C, D, E. You can't, right? Because there's many different features for each type of cryptocurrency, right? Some of them are essentially utility tokens. Some of them are essentially deferred revenue, so to speak. So there's many, many different conclusions that you might reach. What might be helpful for you is if you have an accountant, you can go through our Institute of our ISCA. ISCA is our accounting institute in Singapore. They have issued a financial reporting guidance on cryptocurrency, right? It's very easy to read. Even a non-accountant should be able to digest. I would suggest you take a look at it. Okay, there is guidance out there, but in the Singapore context at least. Okay, I hope it is a satisfactory answer for now. Let's move on to the next question. Subletting rental revenues. Is there any fair value required? Subletting rental revenues, good question. For sublet revenues, it's essentially sublease, right? Sublease income. There's a specific accounting standard just for sublease income, right? The accounting standard deals with lease income and lease expense, right? And there's really, it's not a fair value question anymore, right? It's a matter of, well, let me put it to you this way. Fair values are not necessarily required as much as the other revenue streams, right? So rental leases, there's a separate accounting requirement for that. The requirement to do fair valuation is not so much as intensive compared to other kinds of non-lease revenue streams. Okay, I hope I've addressed that concern to some degree. It's another complicated area, to be honest, leases. Okay, next one. Does mobile app fall within website development costs? Yes, it does. Okay, so you need to determine whether the app can generate direct revenues for you, or it's just a advertising and promo type of cost. Okay. Finally, fifth question, Okay. Last question. My company is a Singapore company with a Singapore dollar functional currency. The funding is granted to us in US dollars in exchange for a percentage shareholding. Is this equity instrument? Interesting question. If let's say you are issuing, so in summary, the question is, this is a Singapore company, but the funding is raised in US dollars, right? And I presume you are issuing ordinary shares. If you are issuing ordinary shares, plain vanilla is equity, right? But if it's an exotic instrument, like a preference share, convertible debt, or some kind of other kind of instrument that has features different from ordinary shares, you may end up having a liability instrument. So I can't give you a straight answer for this because it all boils down to the details in your fundraising contract. Okay, that's the reality of it. So I hope I've answered this question to the best of my abilities, given the constraints. I don't see any other questions. So with that, maybe I'll flip it over to Matt. Matt, would you like to take it away?
Sure, thanks, Gamazzi. So I guess if anybody does have any other questions for Gamazzi, feel free to put those into the chat, or the Q&A box. We can return to those after we've addressed the tax. Similarly, if you have any questions regarding what I will talk through around tax next, feel free to pop those in the Q&A box. So as Gamazi said, and as MJ introduced at the beginning of the session, the second part of this presentation will focus on high-level issues from a tax perspective. You perhaps won't be surprised to hear that tax, like accounting, can get very complex very quickly. So the intention here is not so much as to get you fully up to speed with tax issues that might be relevant to you, but instead to just give you an idea of the types of things to look out for and some important messages for you to take away that are hopefully helpful as you move forward and sort of going back to considering particular issues from your business perspective. So I'm just loading my screen. Hopefully everybody can now see that. Just give it a moment. So as I mentioned, the intention is to keep things pretty brief. I will provide a high-level overview of key tax matters and some points to note, and then move on to explain some key takeaways. I think the first point to note is that, like accounting, tax really touches everything. And whilst tax is often considered a compliance issue, proactive management of taxation can produce cost savings, and it helps maximize working capital through mitigating risks and potential tax leakages. A second point to note is that, contrary to what many people believe, tax does not simply follow accounting. So, for example, to touch on a couple of matters that Gamazi discussed, there are separate tax rules for revenue recognition, and there are also discrete considerations that need to be considered for things like debt and equity classification of instruments. So to begin with, I'm going to walk through some of the material Singapore taxes, the first being income tax. You'll all be familiar with income taxes. We all pay as individuals on our income, but the way the rules apply to corporates is different. So to provide a bit of a health warning, what we discuss today might not apply in the same context to each of you as individuals. So perhaps just keep that in mind in terms of what we're discussing and any key takeaways. So for purposes of income tax, unsurprisingly, it's in the name, only income is taxable. You might know in Singapore, capital receipts are not taxable. Now, one problem that we do grapple with on an almost daily basis is that there are no statutory provisions that stipulate what comprises income and what comprises capital. So we typically have to consider principles identified in case law in order to make a determination. Now, there is unfortunately no bright line test, and it's necessary to make a holistic judgment case by case, which is something clients ask me to support with frequently from a professional perspective. That said, in general terms, trade and business activities will generally produce income, which will be expected to be taxable. Investment activities will often produce capital gains, so may not be taxable, but depending on the circumstances. And investment returns will usually comprise income, and they may be taxable, again, depending on the circumstances and the profile of the activities. Now, even if a receipt is determined to be in the nature of income, Singapore has what's called a territorial system of tax. And that means that such income will only be taxable in Singapore if that income is sourced in Singapore, or if it is sourced outside of Singapore and then subsequently brought into the country. Tax residence, which is a concept that some of you may have heard of or be familiar with, is not directly relevant to whether or not a person or company is taxable in Singapore, but where a company is resident can affect how it is taxable. Now, in general terms, trade and business income derived from activities carried on in Singapore will be subject to income tax at the rate of 17%. Now, when determining what specifically is subject to tax and what you pay tax on, tax deductions may be available in respect of costs incurred to produce taxable income. Now, the statutory requirement specifies that the deductions and the expense will be tax deductible if the relevant cost is what's referred to as wholly and exclusively incurred to produce income. In addition, the costs have to be revenue in nature and not capital. And that's a function of Singapore taxing income and not capital. The corollary of that is that you can get tax deductions for income expenditure, but not for capital expenditure. Now, in addition, for expenditure to be deductible, if that expenditure is payable to a related party, the cost must also be arm's length in nature. So effectively, no more than what would have been payable to an unrelated third party. Now, I mentioned capital expenditure generally is not tax deductible, but depending on the actual nature of the expenditure and what it was expended on, it might, however, be possible to claim capital allowances in the computation of the chargeable income for income tax purposes. Now, capital allowances are essentially tax deductions which are given in lieu of accounting depreciation and amortization. So the starting position is that you get no deduction for capital expenditure, but you may, however, get some deduction for the subsequent depreciation of the capital asset. Now, an interesting point to note for SMEs in particular is that the first 102.5 Singapore dollars of net taxable income benefits from full exemption from income tax. A similar exemption applies to startups within their first 3 years of operation, which exempts their first 125 Singapore thousand dollars of income, after which the former exemption that I mentioned applies. It's also worthwhile mentioning that losses may be carried forward for future relief or for relief in future periods, potentially indefinitely, subject to there being no change of control of the company. If there is such a change of control, that does not automatically mean that losses cannot be carried forward. It just means that there is a requirement to go to IRAS to seek consent in order to be able to obtain relief for those costs in future periods. Now, from a compliance perspective, there are 2 income tax filings required each year: an estimated chargeable income, which is due within 3 months of your financial year end, upon which IRAS will raise a tax assessment and upon which you'll begin to pay income tax. And then later in the year, a tax return by the end of November, which you will report your actual income on. A tax paid owing to IRAS is then trued up against the return. So to the extent you start paying installments based on estimated numbers, when you file your actual numbers later in the year, the balance of outstanding installments is then rebalanced to make sure that you're only paying tax on what you've ultimately reported. Now, certain exemptions apply to filings, which may be relevant depending on your profile. Similarly, there are different forms of tax return, each requiring different levels of detail. And the form that you will be able to use also depends on your profile, and whoever supplies you with tax compliance support should be able to advise on this. So just to recap, there's a bit of detail on here. That the key points are there's a bit of complexity behind what specifically is taxable. Again, some complexity around what is deductible, but in general terms, your taxable income is at a very high level your gross income less any allowable deductions. You do get an exemption, or you can claim an exemption for a good decent amount of your first income, either $102.5 thousand or $125,000, depending on how long you've been operating, and then the balance is taxable at 17%. There are 2 filings, one within 3 months of your year end and one by November of the following year. So moving on to the next tax, which is GST. The first thing to note about GST is that it applies to supplies of goods and services in Singapore in the course of business by a registered or a registrable person. Now, in order to determine whether you're registrable, what you have to do is look at your the value of your supplies over a 12-month period. You will be obliged to register for GST if your taxable turnover during the year is more than 1 million Singapore dollars, measured at the end of the relevant calendar year, or you could alternatively become registrable at any time if you are able to project at that time that you are likely to make taxable supplies of at least 1 million Singapore dollars within the next 12 months. Now, this registration point is likely to be a key point to note for this audience, given that depending on the stage of development and growth you're currently at, you may not currently be GST registered. It's worth keeping that $1 million threshold in mind, because when it looks as though you may hit or exceed that amount, that really is your trigger for having to then take advice and potentially obtaining a GST registration. It's also important to note, but it's not something that I specifically mentioned on the slide, that there are alternative ways in which GST registration obligation may apply. I'll touch on those a bit more in a little while. I think this is a point specifically to call out for any of you that are in the audience today that might be engaged in cryptocurrency or the supplies of digital payment tokens. Now, you may all know that GST is a consumption tax. It's borne by effectively the consumer in the supply chain. So in simple terms, as a GST registered company, you would pay GST when you acquire goods and services, and you will charge GST to your customers when you provide them with your goods and services. The net amount of those two is then either payable to IRAS or recoverable by you from IRAS. When you make supplies of goods or services, the rate at which you're required to charge GST depends on a number of factors. Now, I think based on the profile of the audience today, I think the general expectation is most of you are service providers. So just to call out that for supplies of services, the rate is 7% if you're supplying services to people in Singapore, or 0% if you're supplying services to people outside Singapore. And to also just mention that you may have seen in the budget announcements a few weeks ago that the GST rate will increase from 7% to 8% next year, and further to 9% in 2024. Now, suppliers of certain types of services are exempt from GST. So exemption is a third class of supply, in addition to standard rated and zero rated. Now, exemption itself can be complicated, but what it means at a very high level is that GST does not need to be charged on an exempt supply, but the relevant costs, the GST costs that you incur in order to be able to provide that supply cannot be recovered from IRAS. So what exemption effectively does is change the place in the supply chain at which the economic burden of GST sticks. Now, supplies of certain financial services, investment precious metals, and real estate interests are usually exempt. And as I mentioned, perhaps importantly for this group, supplies of digital payment tokens are also exempt. I mentioned earlier that there are other ways to potentially become registrable for GST. One of those ways is if you do make exempt supplies, and the detail there, or maybe a footnote there just to call this out, is that if you do make exempt supplies, you import from overseas a certain minimum level of services, you may be required to be registered for GST, and you may acquire what are called reverse charge obligations. Now, if and when you are registered for GST purposes, filings must be made with IRAS, typically quarterly. But if you would be in a credit situation, so that's if your your input tax, so the tax that you pay to your suppliers, exceeds your output tax, that is the tax that you collect from your own customers, and you are in a credit situation, you can apply for GST exemption. If you are in a debit situation where you do have to pay GST over to IRAS periodically, if quarterly is perhaps a bit too frequent, there are other reporting periods that can be applied for to IRAS. Moving quickly onto the next slide. This slide focuses more on a category of taxes rather than a specific tax. And that is a category of taxes called withholding taxes. Now, this is essentially a series of taxes applied to certain types of payments from Singapore to persons that are resident outside of Singapore. Now, key categories that I'd like to highlight are those relating to dividends, interest, and royalties. So if you have payment of dividends, interest, or royalties cross-border, one alarm bell that should maybe go off is to ask whether there are any withholding tax implications that need to be considered. From a Singapore perspective, Singapore does not impose withholding tax on dividends, but many other countries do. So if any of you or your entities own subsidiaries overseas, you might experience withholding tax paid by such subsidiaries when those dividends are paid to your Singapore companies. Singapore does impose withholding tax on interest payable to non-residents, and that's charged at a rate of 15%. And Singapore also imposes withholding tax on payments of royalties to non-residents, and that's payable at 10%. Now, another category of withholding taxes that I'd just like to reference applies to cross-border payments of service fees. Now, withholding taxes with respect to service fees are much less common than the other types of payments that I mentioned, and they are most commonly imposed by developing countries, more so than developed countries. Singapore only charges withholding tax on certain limited categories of services, and only in certain cases. So on the slide, you might see a reference to payments of management fees across border or for technical services. In those cases, there's the potential for withholding tax to apply on the service fees paid to an overseas recipient, but that's just something that would need to be considered. Now, one important point to note is that even if any of these withholding taxes that I'm talking about does apply under a country's domestic law, full relief or potentially a reduced rate of withholding may be available under an applicable tax treaty. Now, such relief must typically be claimed by way of application to the relevant tax authority. So if, for example, you have a Singapore entity which is holding a subsidiary in Indonesia, Indonesia does charge a dividend withholding tax. I believe that's 20%. If the Indonesian company were to pay dividends to its Singapore parent company, the Indonesian payer would have to withhold 20%, but there is a tax treaty between Singapore and Indonesia which reduces that rate down. From memory, I think it's to either 10 or 15%. Now, in that case, because it's effectively the Indonesian tax authority which is providing the tax relief, the application must be made for relief to the Indonesian tax authority. Now, a couple of points to just draw out with respect to withholding taxes is the first is that a withholding tax is generally a cost to the recipient of the payments, not necessarily the payor. But under Singapore law, the payor is treated as being secondarily liable for the tax. So it's important that where you are making payments across borders, that you ensure that withholding obligations are properly identified and discharged, as if not, there's the potential for IRAS to come knocking at your door in order to recover the tax that should have been withheld and paid. It's also not uncommon for those of you that have taken debt finance from overseas banks, for the banks to pass interest withholding tax costs that are incurred on payments of interest to them back to you as the borrower. So if you're looking at loan agreements or you're potentially looking at taking loan finance from overseas lenders, it's always worth having a look at the facility agreement or the loan agreement to see whether there is a provision called a gross up, which deals with this passing back of the interest withholding tax cost back to the borrower. Now, from a compliance perspective, where a payment is subject to withholding tax, a withholding tax return must be filed by the payer by the 15th day of the second month from payment. I should caveat that's for Singapore withholding tax. So to the extent you are making any payments from Singapore to an offshore location that is subject to withholding, you as the payer have a filing obligation to IRAS, even though economically the ultimate tax burden may be your counterparties. Therefore, it's particularly important to just keep in mind that if you are engaging in international transactions, that not only do you identify where the withholding taxes might be applicable, but do keep in mind that the compliance obligation that arises in connection with those, to just make sure that you don't fall foul of any of the rules in such way as then might cause you to be subject to penalties. Now, moving on, I'm going to move away from specific tax types to how some of these different taxes apply. And the key point drawn out by this slide is that you'll see that tax really touches virtually all of your different activities, and unsurprisingly, treatments can be complex. And further, that the level of complexity can increase as your corporate group grows, as you engage in more transactions, and as your supply chain becomes more complex. Now, as mentioned at the outset, tax is often viewed as a compliance function, especially for startups and SMEs, as costs and resources are obviously limited, so you don't necessarily want to be paying advisor fees on something that is not considered to be entirely business critical. However, what we see in practice is that as your businesses grow, a proactive approach to tax management becomes increasingly more important and can be increasingly worthwhile, as it can help identify and mitigate tax costs and compliance frictions, and help identify how you might streamline transactions and potential compliance obligations. So just with that in mind, there are a number of different things that you can consider if you do want to take a proactive approach to tax management. The first is that some form of tax health check can be helpful at any point, but particularly where you do have growth plans and are potentially thinking about moving to implementation of those plans. Also, engaging with a tax advisor on a frequent basis to feed into how you might implement transactions and more generally your business plan can help maximize working capital through identifying potential cost savings and taking steps to make sure that any tax frictions are identified and effectively mitigated. Now, to finish off, before we move to take any questions, given that I know many of you will also be interested in acquiring investments or making investments of your own, I also just wanted to touch on how tax touches mergers and acquisitions. Now, the key points to note here are that due diligence really is critical, and that tax implications of share sales and asset sales will typically be different. So the table on the slide explains some of those key differences. One material difference to draw out is that if an investor were to acquire your company, or if you were to acquire a third-party company, you or the investor is effectively acquiring the target company in its entirety. And because you do acquire in the entirety in that manner, you effectively acquire all of the company's tax positions and liabilities. And if there is anything there that has not been handled particularly well, you potentially then take on a tax exposure, and your investment then becomes subject to the tax exposure at the target level. Now, to ensure a robust approach to tax management in this type of case, and therefore of importance to companies looking for investment, it's important to consider taxation when you're considering making investments or acquisitions of your own, given that you do potentially have, potentially you become subject to the exposure of the target's positions. So you'll quite often hear people refer to due diligence from a number of perspectives, either when you're acquiring an investment position in an acquisition context or potentially a merger. The key thing to draw out here is obviously the level of complexity that I've just touched on for income tax, GST, withholding is relatively high. It does increase when you have complicated businesses and business models. And if you are going into a merger or acquisition context, tax due diligence should be one of the categories of due diligence that is being completed, particularly given the risk of taking on the target's exposures. And if that is not viable, you may then consider potentially shifting away from a share deal to an asset deal, in which case you're able to cherry pick the assets that you wish to take and leave behind any liabilities that may be identified through due diligence. So with that, that's pretty much everything I wanted to touch on from a tax perspective. I guess maybe if I could take any questions next. And okay, Gamasi, the first question that we have is around what's referred to as a SAFE, and I don't know whether you've come across this, but a SAFE stands for Safe Agreement for Future Equity. And this is basically an equity warrant, which a lot of sort of stakeholders are currently using in order to raise funds. The question is, how is a SAFE considered in the balance sheet, debt or equity? Do you have any thoughts or comments around that?
Hey, hi, Matt. Actually, I've answered, I've touched in the answers. So for the benefit of everyone who may not have seen the answers, these are essentially convertible, like Matt said, these are convertible instruments. And generally speaking, convertible instruments could be either debt or equity, to be honest, right? What would make it debt would be things like if the conversion results in a variable number of shares being issued, okay, or whether the currency, right, that is in the SAFE instrument is in the functional currency of the company. If it's not, it's likely going to be a debt instrument. So the other question related to this, if you don't mind, Matt, is somebody asked, what are the common practices out there? The answer is it really depends on the term, right? I don't have a sense as to what are the commonly issued instruments out there in respect of SAFE instruments. It all boils down to the terms, two of which I've shared with you before, which is the currency, as well as the, whether it's a fixed number of shares or variable number of shares. Yeah. Matt?
Yeah, thank you.
Yeah.
I guess moving on to the next question, we have a couple of tax questions. So the first is, does acquisition of customer contracts from a third party, sales to be fulfilled in the future, have any tax implications, be it GST, income tax, etc.? The answer to that is yes. There are a number of different factors. So if we start off from a GST perspective, the question is whether the supply of a contract in that manner would be subject to GST. Now, the way the GST rules are structured, the GST Act actually specifies that a supply of anything which is not a supply of goods is treated as a supply of services. So the likelihood is that from a GST perspective, a supply of a contract would perhaps be considered to be a discrete supply of a service. And then you would have to look at the other factors within the transaction to determine whether or not that is made in the course of a business by a registered or registrable person, and if so, whether there might be a GST liability to account for in connection with the purchase price. From a high level, if we say a supply of a contract between two persons in Singapore, my expectation would be that it would be subject to GST at standard rate, so currently 7%, albeit I wouldn't entirely say I was certain about that. That's a gut feel. I'm pretty confident that will be the position, but I perhaps just want to verify that offline. So if anybody has that as a particular case that needs some input, I perhaps suggest speaking to a GST professional in connection with that, given that there could be some peculiarity depending on the overall fact pattern. From an income tax perspective, things are a little complex. So I mentioned when I was talking about income tax that I discussed this concept of income and capital in the context of both revenue recognition and also eligibility for expense. If you were to acquire a contract, so you were to incur expense in respect of that acquisition, the likelihood is that that will be treated as a capital expense and therefore not tax deductible. Now, correspondingly, the receipt for the transferor of the contract would likely be treated as a capital gain, so not taxable if they were in Singapore. Now, there is specific case law about this point. It's not something that is readily apparent from the Income Tax Act, but there are 2 or 3 cases that do spring to mind that do consider this, and they do support that position that I've just explained around effectively a contract being part of the machinery of a business, and therefore a realization gain or income derived in respect of that expected to be capital in nature. Albeit, I would mention a general caveat around there is no clear dividing line between income and capital. There would be a need to maybe consider the wider facts and circumstances to make sure that there was nothing that would impact that type of analysis and consideration. And the final question that we currently have is, as a growing startup, what areas within taxation should be highlighted or prioritized? And I think this goes back to the points that I was making in the final 2 slides around tax, around what type of approach to tax management do you want to take? For startups and SMEs, as I mentioned, it's not uncommon for tax to be seen as a compliance function, particularly given that tax is a cost center. Quite often, people don't understand where the value add from tax advice is sufficiently to be able to then say or justify going out to an advisor and taking advice around how tax may be proactively managed in such a way as to try and mitigate risks and to also try and generate cost savings. I think the key point to note in connection with this question is that we do, as tax advisors, see there being quite high value in proactively managing tax exposures. As I mentioned, tax really does touch pretty much every aspect of business and your operating model. Making sure that you have a proactive approach to identifying what the tax liabilities might be, where there are compliance obligations, is something that is very highly recommended, given that as a tax advisor, I do see situations whereby somebody may have not necessarily done something upfront. A problem might have been identified only upon that then being identified by the tax authority. And at that point, it is generally more costly to address than having taken a proactive approach and address things from the outset through a more sort of diligent and proactive process. So what areas within taxation should you focus on? Well, thinking about or being aware of your registration obligations. So to the extent that you are generating Singapore source income or Singapore taxable income more generally, being mindful of the fact that you do have 2 filings a year, one usually in Q1 if you are a calendar year and financial year, and also one in Q4 at the end of November. For GST, be mindful of the 1 million registration threshold, and also be mindful of the fact that if you are making exempt supplies, there is the requirement, or there is a potential requirement to register. From a withholding tax perspective, do be mindful that withholding tax should always be an issue when you're engaging across border, not only from a compliance perspective, but making sure that you have visibility of potential tax liabilities upfront, so that you can then take an appropriate approach in your costing methodologies to make sure that your service fees income or your trading income is not eroded. So there isn't a straightforward answer. I think the way I would characterize all of this is fundamentally, I'd be encouraging you to try and not think about tax as a compliance function. Think about how you might approach tax management more proactively. Have a conversation with a tax professional if you're not already doing so, and do that frequently, because they are, even though they focus on tax, you will find them to be sort of quite valuable business advisors from a more of a generalistic perspective as well. So definitely something that's worth keeping in mind. Okay, another question that's just come in. For a startup, when do they need to think about transfer pricing from the onset, or when should they think about TP? So transfer pricing, if you haven't come across the term before, is basically a requirement where you are engaged in transactions with related parties. So the general requirement is that if you do engage in transactions with related parties, there is an expectation of tax authorities that you engage on the same or similar terms to those you would engage in if you were engaging with a third party. The motive there is that the tax authority doesn't want you shifting profits to low tax jurisdictions, and it doesn't want you inflating expenses in higher tax jurisdictions. So transfer pricing is all about making sure that you realize and recognize the correct amounts of income and therefore tax in each of the jurisdictions that a relevant transaction might have a touch point with. Transfer pricing, as I mentioned, is a consideration where you have transactions between related parties, given that if you transact with third parties, those are inherently on the same terms that you would engage with other third parties on. And going to the point at which you should start thinking about TP, there is no, I think, specific answer to this. I think it ultimately comes down to maybe a risk approach. So if you have high volumes of related party transactions, high revenues from related parties, the likelihood is that if you are reporting those through your income tax returns and IRS has visibility of those, there's the possibility for tax audits or for inquiries from the tax authority to determine whether you've done sufficient analysis in order to justify any markups or profits that you are reflecting in respect of those transactions. If you are engaging in a relatively low volume or of those transactions, or the transactions have much lower value, then I guess in principle, transfer pricing should be less of an issue for you. I think as you start to increase in size, as you start to be sourcing more products, services from related parties, transfer pricing should become more of more of an issue for you and something that you should be thinking about. If you speak to your tax advisor, they will be able to give you transfer pricing advice that is proportionate to your current stage of development. So if I think about some of my own clients and some of the work that we do with my transfer pricing colleagues, if you just need something relatively high level that just substantiates that something is arm's length, they can provide high level input in a very cost effective way that then gives you something that you're able to use to demonstrate that you've taken a proportionate approach to transfer pricing. If you do have high volumes of transactions or potentially transactions which are very bespoke, very highly tailored, where it's not very easy to find a comparable service being provided elsewhere in the market that enables you to determine what you should be charging for transfer pricing purposes, that's where more specialist advice can be helpful. And that type of specialist advice can involve a couple of different things, one of which is what we call benchmarking, which is more of a quantitative and a qualitative analysis of both comparables and other costing methodologies to determine what might be a reasonable approach to charging your related parties. So I think the key point is there isn't a right or wrong answer around when in particular you should be considering transfer pricing. Transfer pricing should always be a consideration if you have related party transactions. There's a range of different advice approaches that your services providers can help you with. Only as you do become more mature, as your transactions become more complex, or if you have sort of a high volume of related party transactions, that's the point at which you maybe should be considering more actively taking specific advice. So I guess with that, we're about at time, and apologies because I know, Gamazi, I know you need to drop, but maybe before we just finish up, does anybody else have any other questions that you maybe just like some quick input on before we close today? No? Well, I think in that case, I believe the SFA team will circulate a copy of the slides that we've been referring to today. Those have been drafted in such a way as to try and give you something you can refer to going forward. I think they do also contain Gamazi's and my own email addresses and profiles. If anybody does have any questions after today, feel free to reach out. And with that, I guess thank you to the SFA team, and MJ, back to you.
Thanks, Matthew, and thanks, Gamazi. I think he left already. So I'd like to thank everyone again for taking the time to be here, and also to Deloitte for spending the time to educate us on the importance of tax and restructuring for the fintechs from startups to the big guys level. So we'll definitely be sending you guys a post-event survey, and it'll be great if you guys can share your feedback on the webinar with us. And also, if you guys have any more questions for the Deloitte team, I'll be happy to link you with them. So if you're interested in more of such events, do keep a lookout for our weekly newsletter that has our upcoming events listed. Thank you again for joining us today, and we'll see you next time. Thank you, everyone.
Okay, thanks then. Bye.
Bye.